Hello everyone, welcome back to the bootcamp. This is episode 2.1, where I'll go over the basics. It's a complete beginner foundation episode, so I'll be going over everything that you need to know before we endeavor into episode 3, 2.2, 3.1, 3.2, 3.3, where I go into the more detailed stuff, into the more theoretical and practical frameworks of my trading strategies. And as I said, this bootcamp will be for any trade at any level. So I'll be doing this bootcamp for completely beginners that don't even know which charting tools to use, which brokers to use, what prop firms are, what candlesticks are. And I think this gives me also a better start on giving certain viewers also that necessities, those core foundations that you need as a trader. So even when in episode 3.1, 3.2, I use certain abbreviations or I use certain terms, then you're also familiarized with it within the earlier episodes. So I'm trying to keep this as beginner friendly for 2.1, and then 2.2 we go into more in-depth beginner strategies and beginner terms and beginner tools or whatever. And then episode 3.1, 3.2, 3.3, and so on, we're going to go into the real framework, the real trading strategy, the real execution of my trades, the real charts. We're going to go into everything that I really use, the indicators, how I trade, why I trade, the context, the bias. And I don't want to get into it immediately without giving you guys a foundation introductionary, without giving you guys an introduction to the core things of trading. If you don't even understand what candlesticks are, if you don't even understand how candlesticks are formed, if you don't even understand what a market is, if you don't even understand where to start, then there is no use to go into episode 3.1 and 3.2, etc. Without knowing the basics of trading, without knowing the basic principles of trading. So let me already start with covering for who is trading. Let's put it that way. And as you could see, I sometimes look to the left. I have certain notes open. And as I said, this whole bootcamp will be as raw as possible. Everything will be coming to the top of my head. I'm trying to keep it as logical and I'm trying to keep it as real as possible. I don't want no gimmicks, no fluff, no nothing. Just everything that's on top of my head, along with my notes, so I don't miss key things that I should be talking about, along with my presentation that I've made myself, and I've written everything myself. So this way, even when I read it and you guys read it, you guys get a good idea, and I think everything should be solidly on there. But as I said, everything will be top of my head. I'm trying to keep it as real as possible. I'm trying to keep it as raw as possible. Even now, it's being recorded. We're gonna have minimal edits in, probably some cuts in the beginning or some cuts in thereafter, so we shave some seconds or minutes off, but it will be as raw as possible. And I think this gives you also a better indication of who I am as a trader, and also that I hope that having a raw bootcamp like this helps you see the real truth of trading. Like, it could also be that sometimes I forget certain things, and that's why I have my notes open. I don't know everything on the top of my head. But yeah, so I covered for who this bootcamp is. We're gonna start from very, very introductory stuff, bump it up to the basics, bump it up to the foundations, and then bump it up to the advanced things where the real fun begins, what some people say. But yeah, for who is trading? Trading is not for someone that's already in a sticky financial situation. Please do not be trading if you don't even have another income, if you're not able to put $300, $400 a month aside to learn how to trade, if you're someone that doesn't have enough money to cover their basic necessities, and especially if you're someone that's already living on their own, pays rent, etc., etc., etc. Make sure you have at least 6 months of that covered, even if you don't have a job. And if you have a job, better. Learning how to trade is literally learning how to trade, how to learn an instrument, learning how to acquire a new skill, a new talent, or whatever. So a lot of people, they fool you with their boot camps or whatever, with their courses or whatever. Buy my course and within 2 days you'll be able to trade. No. Nobody also tells you buy my course and you will learn how to play the guitar within 2 days. You need practice, which is the equivalent of screen time. You need to really put in the work yourself. Even a guitar mentor or whatever, or when you're learning how to play the guitar, you're taking it slowly. You're learning the basis, you're learning the foundation, and then you're going to go into reading notes, and then you're going to go into reading the musical sheets, and then you're going to get into learning how to play certain easy melodies, and then you're gonna get into figuring out writing your own melody, let's say when you're advanced or whatever. And this is the same with trading. You're going to learn the basics, you're going to learn the foundations, and do not expect to know everything within the first 2 weeks. Please don't expect that. You won't. It's very easy to say you won't learn everything within the first 2 days, and especially not within the first 2 days. It's going to take time. Take all the information in. You need the screen time to understand what's happening. And as I said, the same like a guitar, you need the time, you need the practice. And eventually, as you're being consistent, remember the word consistent. I think I'll be using that a lot, and it's the most important term within trading, consistency. You need to consistently practice. Same like a guitar, same like if you want to play in the NFL, same like whatever else. You need consistency. You can't be learning to trade today and ignore it for a week and then learn again within 2 months and then ignore it again. You need consistency, like everything in life, You need consistency, you need discipline. You shouldn't be strategy hopping, but we're going to get into that all later. So, yeah, episode 2.1, the basics, complete beginner's foundation. Welcome to your first step into the world of trading. This is where your journey begins, not with get-rich-quick promises, but with solid fundamentals that will serve you for your years to come. And as I said, I'm trying to build a solid foundation for you guys, so you could build on top of that. So you have a strong core that later, when you also start experimenting your edge and experimenting other stuff, that you always could rely on those foundations. Because whatever you do later, whether you trade commodities, whether you trade metals, whether you trade forex, whether you trade equity, whether you trade futures, whatever you do, those basics for everything will stay the same. And having the basics good helps you avoid bad practices and bad habits. Who trading is really for, as I already said, I'm trying to be as honest as I can. I'm not trying to sell you a fake promise. I'm not trying to sell you myths. I'm not trying to give you hype and over expectations. I'm trying to keep it as real as I can. The reality check. Trading shouldn't be your only income when you're starting out. Relying on it too soon creates heavy psychological pressure, leading to fear-based decisions and poor trading. Having another stable income gives you the freedom to learn and improve without financial stress. So please, you shouldn't be trading if you're not even able to get by every month. Because trading requires upfront capital. You will be losing money initially. You will be losing money. Trust me, you're not going to be making money, especially if you're just starting out. The smart starting path. In the first 6 months, consider using prop firms. They give you capital to trade with without a large upfront investment, letting you build experience and screen time without risking your own savings. It's essentially a low-pressure apprenticeship where you practice with real money while the firm carries most of the risk. So when I started trading, prop firms didn't exist. So the way that I had to tackle this was open a broker and have a paper trading account, trade with fake money with a paper account, and then carry on everything I learned into a real account, and I would still completely fumble, blow up or whatever, because trading in a fake paper account and trading in real life, real environment market is completely different. And for me, if I had to start trading and I wanted to trade large cap or small caps, I at least needed to deposit at least $1,000, or I wasn't even able to short or long certain large cap. I wasn't even able to short small caps without having $2,000-$3,000 on my broker. So every time I wanted to try, if I was ready for the market, it would cost me $2,000 to $3,000, and that would be 6-7 months of me working in the supermarket as a part-time job when I was still a student. So things are very easy these days with prop firms. You can just pay $30-$40 and you could get a 25K, 50K account. So you have 25K, 50K capital, but of course there are drawdowns and max loss limits set to it, and you need to reach a certain profit target before you're able to go into a real trading environment where you're able to get payouts. But I think it's still nice. Prop firms still give you the ability to get rewarded for the work you put in. I wasn't getting rewarded when I was paper trading, even if I had a phenomenal month, and I was getting lucky and I did well. I wasn't getting rewarded for it. I made $0 on it. Zero. But with prop firms, at least you'll get rewarded for it, even if you do good. So let's say you're testing yourself out and you're very disciplined and you're being consistent and you have a banger of a month. You're getting rewarded for that. You're going to pass your account. You're going to pass the evaluation phase. You're going to get into a real demo trading environment. And if you do well, you can get a payout from that, whether it be $500, $1,000, $2,000, whatever it be. At least you get rewarded with it. And I think the risk to reward, like what you put up front as an investment and what you could get back, especially as a beginner, is phenomenal. Like you could be risking 20, 30 bucks, 50 bucks max tops. And worst case scenario, you're probably going to blow the account. Like there's no doubt in that. Like if anybody tells you otherwise, they're lying to you. But after 6, 7 accounts in a month, let's say, and you're already down 250 bucks, you could probably have a nice month. But don't beat yourself up for it if you don't. It's very normal to not do well in the first coming. As I said, do not think that you should be doing well, especially within the first 6 months of starting to trade. Especially even if you've been trading for a year, if you never had a real framework, if you never had the real basic foundations, don't put too much stress on yourself. Like it's normal to not do well. People, I was trading 2019, 2020. I only started seeing real money 2021. That's 4 years ago, 5 years ago. 7 years ago, started trading. 5 years ago, I wasn't making much, but I started seeing like 200, 300 bucks every day, and then 150 bucks every day, and I was netting $2,000, $3,000 a month, and then it obviously, as you're getting confident and as you have the experience, it started building up. But the whole idea is, do not give yourself harsh expectations, do not give yourself over expectation, and do not give yourself under expectations either. Find a good balance. And consistency is one of the most important things. If you're starting to learn how to trade, be consistent with it. Do not be learning to trade this week and then next 2 weeks you don't have time, and then you're going to ignore it for another month, and then you're going to start again. It doesn't work that way. You need screen time nearly every day, preferably every day. And if you're not, create a fixed schedule for yourself. You need to have, if you're able to, dedicate 2 hours every Saturday, 1 hour every Monday, 1 hour every Thursday. That's way better, doing that consistently for over the course of 6 months. And I guarantee you, you're going to make it. I guarantee you, if you're able to be that consistent with learning how to trade, that will later reflect back into your discipline and trading strategies as well. Because remember, consistency is a very key word. I'll be using that a lot within the whole bootcamp series. You need consistency with everything. Just like learning how to play the guitar. You need consistency. You need to be practicing every day, preferably every day. You need to give it time. You need to absorb the knowledge and let that knowledge marinate within you, and then practice every day. I could be learning theoretically everything, but if I'm not putting it to practical work, then I'll not be learning anything. So give it time and be consistent with studying the charts. Be consistent with everything. And we're going to get all into it. Like I'm going to even get into journals. I was going to do that, but I'll probably even show you guys some journals on how I used to journal when, it was when I started trading out. I think they're from last year, because that's the only thing that I still had. All the other journals from 2022, 2020 are on my hard drive. But I think it should give you a nice indication on how I journal. And I think for someone like me that I don't think I really need to journal anymore, or I need to, but not as rigorously as I'm doing it right now. I think I should be focusing more on data, which I am, but I still journal rigorously, and I'll show you guys what I mean with it. You'll be quite surprised. Learning trading is like learning an instrument. You get the frameworks, just like learning guitar chords. You'll learn trading models, patterns, and strategies. They are your foundation. So what I did in this case is I'm comparing trading, learning a new skill, with learning how to play the guitar, which is also a new skill. I think this resonates with a lot of people easier. So this way you don't put crazy expectations for yourself, just because when you're starting to learn out from zero experience on how to use a guitar, you're not going to be expecting to be perfectly good at it within the next 3 months, and that's the same with trading. Everybody else, any guru telling you that on the internet is lying to you. They're just trying to make your money. I'm here to protect your pockets. So practice builds skills. No one becomes great at playing the guitar or anything in life by just reading a book about it. You need hours of practice, and hours of practice equate to screen time. You need to make mistakes. Within those mistakes, you adjust, you learn from them. What do I do next time to avoid those mistakes? Trading is identical to learning how to play any instrument or learning any new skill. Screen time creates mastery. The more time you spend watching the markets, analyzing patterns, and executing trades, the better your instincts become. So there is no shortcut to trading. There is no shortcut to anything in life. Anyone successful within the trading industry, within the sports industry, within educational industry, within whatever you see in life, whether it's some crazy CEO, whether it's some crazy developer, whether it's whatever, there was no shortcut for them. They've put in the work. They deserve to be there. They deserve to have that success. You deserve that as well. If they can do it, you can do it. But if you're not willing to put in the time, then that's what differentiates you from the rest. That's what differentiates me from the rest, you know? I'm not saying I'm one of the best traders or whatever, but I put in the work and I deserve where I am. I genuinely put in the work, and you'll see that within this episodes. You'll see that within this bootcamp. You know, I went through shit, man. I went through a lot, and there is no shortcut to it. And I guarantee you there's no shortcut. If there was, I would have had that shortcut, you know, but there isn't. You know, I've tried everything when I started out 7 years ago, but man, I was even following signals from forex, from my forex days. There is no shortcut. Nobody's going to do it for you. Anybody telling you that, buy my course, do this or that, and you're going to, it's complete bullshit, man. Save yourself from that headache. If you want to make it and you want to be here for the long run, then there's no shortcut. Put in the time, put in the screen time, put in the work. Be consistent with learning. Be consistent with your journals. On the days where your body doesn't want to show up, where you're lazy, those are the days that count. You know, those are the days where you have to still lock in and journal. When you've had a massive red day, those are the days you need to journal. You shouldn't be only journaling when you have W's and you're happy. So please, there are no shortcuts. Be prepared to go through a real deep, rigorous personal project. Let's put it that way. Be prepared to go through hell, as some say it. Time is your ally. Mastery takes months and years, no days or weeks. Patience with the process is essential. So if we talk about compounding knowledge, a lot of people, they only think about compounding as money. So 1% on $1,000 every year is etc. Is X amount. I don't know, it's 14,000% back in, if you compound 1% every day, that's 40,000 in a year. A lot of people only think, they relate compounding with money. They don't associate compounding with personal growth. 1% better every day is 14,000% better every year. Focus on it. Even if you have that tiny little growth, that 1% growth, that 1% you being better at trading, that 1% you putting more time into trading will pay off in the long run. Time is your ally. Let time do the work. Trust the process. Just literally, it sounds cliche. I know it sounds very cliche. Trust the process. Time will eventually show you that it did for me as well. You know, did for the other people that I'm here trading with, that did for them as well. Let time determine whether you're good or not. Let time determine that. Do not be rushing within the first 2 weeks. You know, even if you're making money within the first 2 weeks, you got lucky, man. There is no way that you're going to be making money within the first 2 weeks where you've never even had any trading experience. You've just got lucky. And I guarantee you within the next year, you're not even going to make it. You're probably going to be done trading. It's just the harsh reality. I'm not trying to demotivate anyone. I'm trying to be as hard as I can. For the people that are not even able to stomach this, you know, I'm just trying to save you from losing a lot of money and having stress and mental discomfort. So trading is like an instrument, you know, it takes time. Even though you get the framework, you know, you get the model, you get the practical lessons, it still takes time to be able to use those frameworks and apply it to real life examples, real life trading, real environment trading. It just takes time. You know, practice equals to screen time equals to learning to be better. And yeah, I even put a note. Don't get fooled by idiots that set lower standards for you, that tell you, oh, within the next 2 weeks, I guarantee you're going to make it. You're not. It doesn't work that way, you know? So yeah, so much written, and it's literally, you know, I have so much to say, and as I said, I'm very excited about doing this. And yeah, you know, I have a key things about consistency, and you know, it's very cliche. Trust the process. Once again, consistently every day, being able to wake up, do the same thing, and trusting the process. Even though it sounds cliche, but trusting the process will make you even probably better than I am, even better than whoever is out there on the internet that you're watching. You know, you're putting in the work. You deserve to be there. You genuinely, everybody can. Trading isn't a holy grail that nobody can. Everybody can, you know, whether you went to school for it, whether you went to uni for it, you know. Yeah, I have a bachelor's degree, you know, and most of my friends, they're already investment bankers, wealth managers, whatever. But I have also friends that have zero experience, and one of them is my old mentor. He dropped out when he was 18 and never really went to school, and he's an 8-figure trader, and nobody knows him on the internet. He isn't even on the internet. He doesn't even use socials. He doesn't use Twitter. He doesn't use Facebook. Doesn't use anything. It's just him compounding his money every day and even ignoring my message time to time. He's completely disassociated himself from the real world, And those are the people that you want to look up to. Make friends with people that have the same intention as you. That's also another key thing. So yeah, consistency. No consistency, no success. Stick to one plan, strategy, and do not be hopping. Trust the process. If you're learning how to play the guitar and within the first 2 months, if you're not able to write your own melody, it doesn't mean you should stop. It doesn't mean you're not able to get there at one point. I don't know much about guitar, but let's say a very difficult song that you're trying to play on the guitar. If you're not able to do it the first month when you just started learning how to play the guitar, it doesn't mean that you should completely stop and give all hopes up and be like, yeah, but I can't do that. It's already been a month. What is a month to learn a new skill? You weren't able to walk the first 2 years of your age. It takes time, even like walking. How many times as a kid, as a baby, how many times do you see babies? They get up, they walk, they fall. They get up, they walk, they fall. And every day, every little step they make extra, they're consistently getting better. That growth is getting compounded. And then they're going to grow old. And they're going to be 8 years, 7 years, 6 years, whatever. And they're walking, running, and that isn't the product of only learning how to walk within a week, within a month, They were consistently busy with, and I know, that metaphor or whatever I'm using it's completely away from trading, but it's just the same framework. It works the same way in life. When you're learning how to trade, whatever strategy you end up learning, whether it's mine, whether it's whoever else, whether you make your own little strategy or not your own strategy, but you're adapting your own strategy and fine-tuning it, you need to be able to consistently follow the strategy. You need to be being able to do that year-round long. So you can't be following your strategy today, over risk tomorrow, get lucky, do that the same day, do that 3 days later, get lucky again, thinking that in the next 3 months you'll be able to do that. No, within the next 3 months, 4 months, 5 months, whatever, you're gonna blow up. You're gonna blow your account, and everything you've done in the past 5 months, you've got nothing to show for. So you need to be able to be consistently taking your L's and your W's and follow your strategy and follow the framework, follow the entry model, follow the exit models. If you're not able to do that consistently and you don't have the discipline, then you're not going to make it. Simple as that. One thing which I also want to touch upon is journals. I've mentioned it, and is there really a tool for journal? There isn't. There are no journaling tools. Well, there are. You've got TradeZella, you've got TraderView, you've got TradeSyncer. And what they technically do is they accumulate data. So whichever trades you took, you could import them from your broker, but you could also manually input them, and you could track your data. You could calculate your profit factor with it. You could calculate your risk to reward ratios with it. You could calculate whatever with it. And the tool that I showed you, let me see if I can still open it up on my Discord. Those are data tools that we use as well, especially for my weekly recaps, as you could see. So I had a weekly for my last week. I had 2.2K in dollars, 77% trade win ratio, and a 6.74 profit factor with a 100% win rate. And this is only for November. For the week, I usually do have losses. An average win-loss ratio of 1.93, which is around a risk to reward of 2. So every dollar I lost, I've made $2. And this for every week. So if you go back to a week higher, again, phenomenal week again. And then, so yeah, do take L's. 21.25 R, 76% trade win, 8 profit factor, 75% day win, and a 2.38 average win-loss ratio. My average win-loss ratio was improved. And you could see here, my average win-loss ratio was horrible. And those are journaling softwares where you could track your data, and it's specifically for your data. However, that's lazy work. So we don't need to calculate our own data. We don't need to calculate anything. We don't need to keep up with 1,000 trades in a year and calculate the trade doing for them or whatever. So using a software like them, that's good. But where does the real journaling come from? Let me show you. This, what I have, is only from 2024 and 2025. I have a whole journaling section again from 2022, 23, and 23, and then 2024, 25 is here. I literally have journaled every chart I've traded since 2022. If I traded Tesla, Nvidia, MAQ for futures, and gold, I've taken a screenshot of every time frame I've used, the 1 minute, the 3 minute, the 5 minute, the 15 minute, and the daily, for every ticker. That's like 10 screenshots per ticker, or 5 screenshots per ticker for 5 instruments. I've traded 25 screenshots, and those 25 screenshots I've annotated all of them. And we could go into some of them. Let's go Tesla journal. This is my specific Tesla journal. You could see 0807 2024 last year. Some of my trades, you can pull them up. This is how they look like. Gorgeous trade. Went long, break even out. As it reclaimed, I'll not be saying the name. I'll go over my strategies, as I said in upcoming episodes. But you could see perfect entry. Added more size. Went out, went out. Gorgeous, gorgeous trade. Gorgeous trade. You could see 0907. Buy long, short, short, short. Every red box is a short, every green box is a long. And you could see I've journaled all my executions. Those are from last year, and I still have every journal. Long, short, long, exit, short, break even out, short, short, loss, short, short, loss, short, WWW, short, WW. And you could see I keep track of everything I've done. Way more cleaner chart. Buy, buy, loss. Re-hit the longs, out. Re-hit the longs, out for a loss, out some more size, add some more, wasn't able to get the continuation, and then I started longing more, and I took the L here, and then I started shorting the backside, short more, massive W, short, 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 as I knew that I was looking for a core level here, and as you can see, the moment it broke my core level, I was all out, and then I re-hit it, and I was able to get a massive rollover and make my money. And as you could see, even for this is how I annotate. First trade FBD, field breakdown. I'll get into what an FBD is. I'll get into my strategies as I promised, but not now, not in this session. Broke, line in sand. What is the line in sand? We'll get into that. Held to high of day. Pre-market highs were broken. Should be more patient with my exit. As you can see, buy. I went out here, some size, out more size, added more, out more size, added more, re-added. I was already all out. Re-added some more, exit everything. And you could see that I add notes for myself. Notes should hold longer, and I have an exit plan. I didn't have an exit plan. Remember, this is just me starting to trade at Tesla specifically, and I realized that Tesla was making wild moves, and Tesla was very liquid. It was behaving very nice for a large cap, and I was very happy trading it. And you could see that my journaling from last year is still stuck within me. It's the product of everything I've done here, and not only for this, everything, is the reason that I'm at the point where I'm at. Look, you could see this. Like, I could even make it bigger. I've crossed out some personal information and everything, but you could see, what do you see? You see, this is my 1 minute chart. This is my 15-minute chart. This is my 5-minute chart. And then I have my 3-minute chart usually here, but then I had the order book on that day open, the level 2. But you could see, I annotate everything. Very obvious. Pre-market tight range. 15 minutes was very bullish. Also seen on the 1 hour. It did the opening swipe. FBD could have already entered at that green line with a mini FBD. As you could see, what do I write? I'm annotating things for myself. Even though I didn't take these trades here, I'm still annotating. I'm still giving myself like what I should have done better. And you could see I have crossed out, but what to do and not to do next time. Scalp, and I don't even know what I wrote there through wigs, blah, blah, blah. But you could see first entry, marked it green, was 1 minute FBD flag. Why did I have my first entry? I annotate why I had my first entry. And a lot of people don't do that. You have to go over all your trades. Why did you take that trade? Why did you exit at that price? Why did you exit at that level? Why did you trade that trade? What setup was it? Under what category did it fall? What was the context of the day? I wrote everything down, and not only for that, even for the 5 minute. What was the 5 minute? What did the 5 minute do? And and you could think that I've only done this for that. Look, G straight. Those are the trades for the day that I took. I also have a separate screenshots for them. And then we're gonna go into 16th of July 2024. My trade, the one that I took. You could see, pulling it up, long, cover. I took a L on it. I ate the L. And then shorted some more. Cover. Made everything back. Look what I'm risking. This is what I'm risking. Look how tight my risk is. And then look when I do short, how much I'm making in retrospect. Like, let's say on average, I made this much. And look in retrospect what this much is compared to here. So you could already see all my trades have very good risk management. We could go my journal. Oh, this is a hell of a read. You could see. I could zoom it in. What do we have? Same thing. I annotate everything, every chart. Tesla on the 5 minute, Tesla on the 15 minute, gave the 1 minute FBD, but the FBO was clean, gave them the break, key point at 255. Next area, 252 was the target. I write my target. As seen on pre-market plan, range was very tight. We were looking for that 257.5. Because I have a plan when it comes to, and you could see I even had some more here and had some more here. And you could see that I write what I could have done. Again, here as well. You know, yeah, unfortunately it's covered by here, but already test the high, what to do next time, what not to do next time. And this is not only for that. Let's go back, 18th of July, same thing, pop up my journal. What to do next time, what not to do next time. No chases, entries better near your levels, so risk is tighter. Trust the 5 minute areas more and use them, don't overtrade. You could see that I'm telling myself things, even though I didn't take trades. See, I'm telling myself that I should have taken a trade here, but I didn't. And me writing down where I should have taken a trade helps me next time on where I should be taking trades. And it helps you, it's stuck in your memory, and it doesn't come only from doing it once, twice, 3 times. It comes from doing it over a year long. And after a year long, it's stuck in your head. And this is like pure journaling. This is what journaling does for you. You know, you could go pause the video, whatever you want to do. You could watch this, you know, and then those are the trades. I don't need to always pull them up, but those are the trades. You could go every green, you could see I add the backside. Who in the future space has such nice entries like me? 0 drawdown entries. Buy, sell, buy, sell, sell. Who has that? Short, cover, cover. Buy. Who has that? No one. You know, see 19. I could go on, I have plenty of those, and you could see they always get better and better. And you could see I took an L on this. I longed. Covered, long cover. It was an L for me that day. And yet look how I'm trying to journal my trade. You know, look at 1st of August, journal, bomb, pull up. What do you see? Everything where I should have taken a trade. I should have taken trades here, you know, and I didn't. I went long instead. Why did I do that? I explained to myself. I tried to understand when I look back at it why I did that, you know, and it helped me just understand what I'm doing wrong and what I'm doing right. You know, we could go, this is only Tesla. We could go into journal stocks. You could see I opened this Meta 1 minute, 3 minutes, 50 minutes, open 1 minute, 3 minutes, 21/07/2025. I have a picture where I should have shorted. I always have the best opportunities of the day. Even some of them I didn't short them or didn't play them. I still have them. 26/06/2025. I don't know why I wrote 26. Circle 1 minute. You could see what was the play on that, you know? And I have in my notions literally text with them. I have the 15 minute. What happened on the 15 minute? What happened on the high time frame? Don't be so stuck on the lower time frames. What happened on the 15 minute? What happened on the daily? What was the context of the day? And you could see I have so many charts. Tesla 15 minutes as well. You could see I mark everything. Put in the work, man. Put in the work. I don't even 907, 9 July 2025 small caps. You could see. Look at this. How many screenshots I've taken. Look at this. Look at this. You know, look at this. On the 3 minute, I have literally charts of everything. Look at this. I annotate everything. Why I should have taken a trade. Why I shouldn't have taken a trade. That's the same one. Let's go to BMNR. You know, I annotate. What do I see? Huge 2 billion offering. Why did this happen? Why did this move happen? If I look back at this in a month or two or a year, I'm not going to understand. If I look at this randomly, I wouldn't understand. Now I understand what happened. There was an offering at market open. This is why we just sold off like that crazy. You know, kids, 1 minute. Do I have anything here? I have my line. Where should I have taken entries? And this is small cap. And then you go into large cap. The same day I've only traded Tesla, you know, and then you're going to get into, I don't know what, 0906. Tesla 1 minute, 3 minutes, 15 minutes. Again, 6 1 minute, 3 minutes, 15 minutes. 2207 already showed that. 2506 everything again. Coin 1 minute, 15 minutes. I have them all. Where I should have taken a trade, how I should have taken a trade, you know. And doing this, having that sense of repetition and doing this. As a matter of fact, I'm doing this every day for the past 3 years for everything I've traded. And then you guys are amazed on stream when I'm able to recognize patterns and I'm able to recognize context and I'm able to tell you, no, I wouldn't short there because of this, you know. There are reasons that I know that. It's all stuck in my head, you know. If you're not as committed like me for trading, you're not going to make it. It's a very difficult game. We're playing against, look at this again, CV, EMPG 3 minutes. I don't even remember what this was. Oh, massive pump up. You know, if I go back to my Notion for that same day, I'm going to have a whole text written on why this happened. Wind, I don't even remember what happened here. But I have them, you know, I have them. Tesla 1 minute. Once again, I have my trading view screenshots, and then we're going to go into, there was journal stocks, there was from my old MacBook. I could literally go futures, NQ, BOOM, same things, NQ, 505, 2025, same thing, November 2025, I have a screenshot of everything. MQ journal plus entries. This is how I traded that day. Look how clean that is. Look how clean that is on the 5 minute, and there are reasons I'm able to do that. Look how clean that is. MQ 5-minute journal. Look, I write everything. Why did that move happen? How did that move happen? 20 November 2024, 24 October, gold 1 hour chart. I have the hourly chart on what happened. You could look at it. I have the 5 minute of what happened, where I should have traded. Did I trade it? I didn't. But I have everything. NQ, regular trading hours, extended trading hours, NQ 1811, NQ 1 minute journal. Look at this. Look at this. And I've written everything down. I've written literally everything down. Yesterday's key level, blue line, FBD. I've written everything down. Why certain things happen, how certain things happen. It's so clean, man. Look what I've went through. I've done this every day. Every annotation is probably going to take you 30 minutes, and trust me, some I have never even ever looked back at it. But during my trading, during the journaling process, it just like a studying session. I study and it just gets stuck in my head, This is from my old MacBook shit. And then you're going to go into stocks. Same things. You're going to see this on every chart I open. Everything I open. 10, 12, everything I open. And then you're journal futures again. 1507. Everything I open is like that here. I have a widescreen monitor at home, and this is how I take dual screenshots immediately at once. The 1 minute here and the 15 minute here. I look at the 15. What happened on the 15 minute? We have been FBO clear backside. So what did I do? I shorted that day. I don't know how to, I hope the guy gives you a sense on how I journal. And trust me, what I've just shown here, just for the introduction, I'm going to go deeper into it along with my charts. I'm going to go deeper on how I journal, what you should be journaling. But that's going to come in the advanced section, not for now, because if I go and tell you exactly what to journal, how to journal, you're just going to get overwhelmed, But yeah, this is just how I journal, to give you a better idea on how I journal. And you can see I have literally everything on there. Futures. Again, anything you open, anything I could open. See how many screenshots I've taken on the 20th of November. Look how many screenshots I've taken on the 5th of December, 2024. 1 November. Look how many screenshots. 31 October. You could even see this. Also my trades. 31 October. 2 May. Let's go into 2024. I'm very interested. 5 December 2024. And make you 1 minute. You could see this. Look how clean this is, man. But yeah. So this is it for the journaling part. And we'll get all into that. Like, as I said, I'll get all into that later in the later episodes. Set realistic expectations. Don't expect success in 1 week. This isn't the lottery ticket. Trading is a skill that requires dedicated learning time, practice, and patience. Short-term versus long-term. People consistently overestimate what they can achieve in 1 week or 1 month and underestimate what's possible in 6 months or a year. Exactly what I've been talking about with that 1% growth every day, being better every day. People are so short-term sighted that they only see what's in front of them, and they're not like, if I work hard now and I sacrifice some of my time and I be disciplined and I be consistent, what I'm able to achieve next year. No, they're only trying to see that short-term success, and they're not letting time do the real damage. And it's kind of concerning if you're not able to do that, even when you're trading, when you're taking a trade, and in that trade, you're in a trade and you're already up $200 and you get out because that's $200 and you're happy with your $200, whereas the trade has the potential to make $2,000, you're shooting yourself in the leg. And that's the same with trading. So set realistic expectations for yourself. Keep it real. Your goal in the first months isn't to make millions. It's to learn, stay consistent, avoid blowing up, and staying in the game as long as you can. And that's what makes the money. Staying in the game. Not making money, especially not losing money, staying in the game. The traders who succeed are the one who approach this with patience, discipline, and realistic timelines. Set yourself up for sustainable growth, not quick burnout. Don't burn yourself out. Don't make things complicated for yourself. Let everything sink in. Let everything marinate, and you'll get rewarded for it. What markets we trade and what markets exist and this is for people that are completely new. We, as Sheikh Group, what we trade futures and equities solidly. Primary focus of this bootcamp will be for futures, and our live streams are all trading futures, but we trade equities on the sideline. So we have a broad experience when it comes to the markets, and those two markets are the most traded markets and the most relevant market for retail traders like you and I. You know, we're not going to be trading bonds. We're not going to be trading, commodities mostly. You can have a couple of trades here and there, but I don't see a lot of people doing that whole year round, just because the opportunities and the volatility is just in other areas of other industries within the market. So what I trade both futures and equities, but in this bootcamp we'll focus on futures market, and everything you'll learn is applicable to equities, futures, CFDs, any market you trade, metals, commodities. What are futures? Futures are contracts to buy or sell an asset at the future date. They're leverage, meaning you can control a large position with relatively little capital. Popular futures include indices like ES, the S&P 500, NQ, the Nasdaq, and commodities. Is it relevant for you to know what futures are? Not really. If you're just starting out, futures are just contracts you're trading. They're leveraged products, and you could trade with little capital, high amounts of future contracts. Let's put it that way. Completely relevant for you to know what it is, and I'll make it as simple as I can for you guys. What is the future market? It's a centralized market where the contracts are traded. You've got market makers, liquidity provider, whatever. You've got big institutional firms that provide those contracts, and future markets allow traders to speculate on price movements or hedge against risk in commodities, currencies, and financial assets. Once again, irrelevant for you guys to know. Don't worry too much about it. How does it work? Traders buy or sell contracts based on where they believe prices are headed, and that's what we call trading. I go long or I buy an asset, whether it's Tesla within the equities market, whether it's NQ, the Nasdaq, which is an indices, the futures market, or whether it's the QQQ, which is the same as the Nasdaq, but then it's on the equities market. Once again, completely irrelevant for you guys to know. Just I'm saying it for the sake of explanation. Whether you trade that, when we take positions, whether me or whoever else take a position, we take those positions because we believe that the markets are going up in that direction, or else I'm not putting money on the line. If I don't believe that the market is going up, I'm not going to be betting money that the market is going up. And I believe that the probability of it going up is in my favor, else I wouldn't take the trade. And that's what you call EV again. And EV will be later explained in the later sessions, because I think EV for now is way too complicated and advanced for beginners. So yeah, price moves constantly as supply, demand, and market sentiment change. And obviously, when the market goes up, there's an influx of demand. More people are interested in that product. And let me give an example with a very, very easy thing. Let's say during winter periods, blankets are more in demand than they are when it's summer periods. And when there's demand, usually basic economic principles, price goes up. And when there's an overload of supply and when there's too much of something in the market, the price goes down. And that's how it works with equities. If there are a lot of shares dumped into the market, price goes down. A lot of shares being bought in the market, price goes up. And those are the basic things, the basic fundamentals why price goes up and down. Most traders don't hold contracts until delivery. We trade them. We don't hold them for delivery. They close position before expiration to profit or lose from price changes. The exchanges use margin and daily settlement, mark to market, to manage risk and ensure both sides meet their obligation. Completely irrelevant. I just put it in there for the sake of understanding what future markets are, but don't worry too much about it. What makes markets move? The how, which why or how the market moves, the why the market moves will be explained in advanced coming episodes. They're a bit too advanced to go on how the market moves, and they're based on strategies or whatever, and we'll cover that in episode 3. But for now, what makes markets move? Liquidity, the availability of buyers and sellers. High liquidity means trades happen easily without moving price too much. So you have liquid markets and illiquid markets. Illiquid markets, you won't see them in futures, but you'll see them in equities, especially in small caps. If there is just no supplies and somebody buys a massive influx of shares and it's an illiquid stock, the price just pumps up very high. But the price could go up 500%, but that still doesn't mean that he's able to sell them at that market price because the market is illiquid. There are no buyers if he sells those shares. And that's what basic liquidity is. And when we're talking about high liquid, that means that future markets where there are technically buyers and sellers nearly every day, whenever you want to buy, whenever you want to sell, you're going to get filled. You don't have to worry about that. Participants, the market has certain participants. You've got retail traders, you, me, the gurus you follow on Twitter, and everybody else. Institutions, large institutions, we're talking about big institutions. Algorithms, could be hedge funds, mostly hedge funds, trading firms, and market makers. Those market makers, they quote the market. They allow for the liquidity. They allow for market efficiency. And they all influence price through their actions and intentions. If an institutional, a big institution wants to buy Tesla, they're going to make sure that they're able to acquire a lot of Tesla shares before the price moves up. If algorithms are active in a market and they're trading those small price inefficiencies, they make sure that the market chops, etc., etc. And we as retail traders have the hardest job in being able to be in an instrument at the right time, be in the right direction, and make money off of it. And yeah, I hope that with this bootcamp, I'll be able to give you guys a very nice preparation to being able to beat institutional algorithms, I hope. But yeah, orders. What are orders? They're buy and sell orders, drive price movement. When more people want to buy than sell, price go up, and vice versa, as I explained with the basic supply and demand economic principles. Volatility. I'm not going to go too deep into volatility. Also, I'm going to be complicating and overwhelming you guys with information. But volatility, in simple terms, is how much and how quickly price moves. High volatility means bigger swings and more opportunity, but also more risk. You're going to have wider spreads. We're going to have candles that are wider in size. So that same 10 shares that you buy or that same one contract that you buy will be different next month, where yes, you're going to be buying that same one contract or that same 10 shares, but when the market is not so volatile, you're going to see smaller ranges, smaller price range. So when you're risking that low of the candle on the two separate occasions, you're going to see more risk on higher volatility days and lower risk on lower volatility days. Introduction to candlesticks. So where do I start from that? Introduction to candlesticks. Candlesticks is the fundamentals of trading. They're what 90% of people use. Some other people use line charts. Some other people use Japanese candlesticks. Some other people use. But I think in reality, candlesticks are the most used, and you should be using that as well. They give you all the information you need. They give you the OHLC, the open, high, low, close. And those four things determine every candle. Markets are fractal. So when you see a pattern on the 1 hour chart or the daily chart, that same pattern repeats itself on the 1 minute chart. And when you're on a 1 minute chart, every candle that you see in a market is a 1 minute candle. And when you're on a daily chart, every candle you see is a daily time frame, 24 hours of that market. And I'm going to be reading it out. And then I'll be showing you some examples where I'll be able to hopefully make you understand things a bit better. So candlesticks are the language of price action. Each candlestick represents price movement over a specific period of time, whether that's the 1 minute, 1 hour, or 1 day. Anatomy of a candlestick. The wick shows the highest and lowest price reached during that time period. It's like the extra range places the price touched briefly but didn't stay at when it's closed. So when a candle opens up, and it opens up here, we'll get into that in a bit in the chart. It opens up here, and it drives all the way back up, but it doesn't close within that 1 minute time period, and it's being sold back down. That little wick, that's called where the price did go during that 1 minute, but it never closed there. The body is that thick part, and it will most likely always be a distance between the open and the close. And the thick part shows the real movement and intent. It represents the opening and closing price. A green-white body, usually green, means price closed higher than it opened, and a red-black body, red, means it closed lower than it opened. So when you've got a candlestick, and the candlestick opens the next 1 minute candle, I'm talking about 1 minute for sake of simplicity, and the next 1 minute candlestick opens, and let's say it opens here. If it goes up from the opening price, you're going to have a green candlestick. If it goes down from the opening price, you're going to have a red candlestick. And that later, those colors and everything are able to give you a lot of information, which we will get into. What candlesticks tell us? They give us specific shapes, and each shape, certain shapes, they tell us strength, weakness, or market indecision. Consecutive large candles, they signal a volatility shift. Large displacement candle shows strength. Grouped patterns of candles together can reveal support, resistance, reversals, and continuation signals. Today is just the basics I've written down. We'll go more in detail in episode 2.2 about each candle and how I use them as well, and how you could use them as well. I can open a quick, candlestick pattern chart that I've already prepared for you guys. Let's see. There you go. And this one as well. So as you can see, candlestick patterns. Don't get overwhelmed with all of this, but so in this case, we have a doji, which is indecision. And this flavor, which I call the dragonfly doji, I just call it the hammer. And I put these two as the same. They indicate strength. So when we open, especially, but you can't just be trading those independently. Just look at the 1 minute chart, see that, and be like, oh, okay, I'm going to be buying. No, as I said, we're going to get into that. Today's just going to be explanation. So I'll be showing you when I use them, etc., etc. And then you've got the gravestone doji and the inverted hammer, which I just called inverted hammer for both of them. And they show weakness in the market. Hanging man is the same as a hammer for me. Strength in the market. And for the rest, this is still indecision. I see them the same like this. And then those two for me are impulse, green candles. I call them momentum, momentum bullish, momentum bearish. The rest, don't worry about them. The basic candlesticks. Just gonna make it a bit bigger. Have the middle on the screen. The opening is, this is the opening. So when you have a new candlestick, let's see if we can draw. Yes, so when you have a whatever candle, we're just gonna do it in black. So I don't need to change the colors a lot, but let's say you have a, do I have free draw? No. Yes. I don't even know how to use this, but so you can't even free draw on this anymore? No. We'll try something else. My paintbrush. Way better. Gonna put this to the side. Put this here. Yes. When you have a candle that opens, that this is a candle, and let's say in our case, this is green. When this candle comes and opens, and let's say this is the next opening price and the new candle is being formed, you have a big candle like this and it's green like that, this is the opening price. So what you got here is the opening price. When it pushes above and price moves, it tells us that buyers were interested in that candle, whether it's the daily, the 1 minute, the 5 minute, the 3 minute. And we close higher, and this is the close price. This little wick that we have around here, that little wick, shows that price all the way went there. So I'm going to redraw it. Sorry for my bad drawing. Price already went there, but then it got sold back down. And what this information gives us within that 1 minute time frame is that we went up, but some people took profit, some people shorted, whatever it could be, but price was pushed down in that 1 minute time frame. And it could also be that it doesn't have any wick, and that usually indicates significant strength. And that's the same case for the low. And that's why what I said is, if you have a hammer candle, which I call them all a hammer candle, shows significant strength, because this is where the price was, and they were immediately within that 1 minute a massive influx of demand, a massive influx of buyers that pushed the price back up. And then same principles for the red candles. So when you've got a price that's like this, candle like that, and then we're gonna go down again like this, and then we're gonna have a green candle like that. This is the open, this is the close, and then we're gonna have the open here with a new candle. And let's say we have a massive candle like that. We know that this is where the price opened. This is where the price closed. Price went down. So we know it's a red candle. We know that price was forced down. There are a lot of sellers. A bigger body means that there are more sellers being pushed down. And what does that show? And then we're later going to get into strategies like this and so, but we'll get into that. I'm very excited to already go into strategies, but this shows that, let's say, price went up, but sellers immediately shorted this back down. Price opened, went all the way back down, and if it has a wick, then it went all the way. This is the lowest point within that 1 minute that it went, and it was bought back up. And yeah, this is it. I'm not trying to go too in detail. I think that most of you will probably by now already know what candlesticks are, how they work, and I think everybody watching this probably already know what candlesticks are. So I'll be opening trading view. Let's remove this. I don't need to save that. Delete. Don't get overwhelmed with all this. Set, we're gonna open the chart, and what do we see? Let's say I'm gonna take this candle out. What does this candle show us? See, again, this is where the last closing price was. Price opened here. Price went down. It went all the way down and it went back up. What does this show? It shows that people are not interested in selling this anymore. You see buyers stepping up. You don't see buyers stepping up here. You don't see buying stepping up here. You see buyers stepping up here. And this shows that yet if this went all the way back above the opening price, we would have ended green. But we didn't, just like this, you know, price opened here, closed here, but we didn't. So we do some significant buying, and then you could see buyers are stepping up, buyers are stepping up, buyers stepping up, buyers stepping up, and then we have that mini pullback that we had. And this is just the basics of how price works. See, same example here, but then this time we did get above the opening price, which turned it green. But this kind of shows a lot of information already. Every candle that you see shows a lot of information. And then we're gonna get into order types. Different order types control how and when you enter and exit a trade. Market orders, execute instantly at the current price. Limit orders, execute only at the better price than the current price. And then you've got stop orders, buy, sell, sell, stop, trigger when price reaches a certain level. Those are irrelevant for you. Only market orders and limit orders are. Well, stop orders are as well, but I wouldn't worry about them too much. Market orders is when you instantly want to get filled and you're okay with being filled at the ask. So you've got a bid and an ask. And let's say when you're buying a house, let's make it simple, car. When you're buying a car and that car costs $10,000 and you're bidding $9,000 and the seller, the guy that asks the money, he's asking for $10,000. That $1,000 in between is what we call the spread. The $9,000 is what we call what's bid for, the highest bidder. And the $10,000 is the lowest ask. And it could be that for the same model of that same car, somebody else is asking for $10,200, $10,300, but the lowest ask is $10,000 and the highest bid is $9,000. So you've got the spread of $1,000. Let's say you're someone that has the money and really want that car and you want to buy it immediately because you're scared that somebody else buys it immediately, and then you have to buy this car, the same exact car, instead of $10,000, you've got to be buying it for $10,500, $10,600. What you call is you're doing a market order. So you'll be market ordering a trade, initiating a market order transaction where you buy it immediately off the ask. No, the bids are not filled. You get priority on getting those shares, but it comes at a cost. The cost is that you'll be buying it a bit higher than the highest bidder, and that's the cost of a market order. You get a bit of a higher entry, the same on price charts, a bit of a higher entry, but you get it instantly. But you could also be doing a limit order, and a limit order is a buy limit. Let's say you want to buy that same car, but you're okay with bidding 9,800. You're not okay with market ordering, but you're okay with limit ordering. So you put a buy limit at 9,800, and maybe the ask drops and fills you. But it could also be that somebody else market orders, buys that car for 10,000, the car goes to 10,500, and now your bid is there for 9,800. Either you gotta wait, hoping it comes back there and you have the patience, or the trade is gone and the market already moved and now you chasing it and you're gonna market order and buy that car for 10,500, and now you've bought it at $500 higher than what you could have bought it when you market ordered 10 minutes ago. And that's the difference between market order and buy order. And then the same for sell orders. Let's say you're in a rush and you really want to sell your car and you see that someone is bidding it for 9,000, whereas the real price is 10,000. You're going to be putting a sell order in, a market sell order, which is going to sell your car immediately at 9,000, but you'll be missing out on potentially being able to sell it for 10,000. And yeah, because you're in a rush. And that comes at the cost of doing business like that. When you want something instantly filled, you're going to be paying a bit of a higher price for it. And what I personally use, I use market orders. When we're talking about markets, we're not talking about $1,000 spreads. We're talking about very tiny spreads, and I'm okay with it. I don't trade crazy size, and I'm not there yet. I'm not entering trades with 7 figures. I'm not taking $1 million trades with my futures. I'm not taking crazy size trades, So for us and for you probably as well, for most of the people watching this, a market order is good. You could put limit orders, and those are, get later into them. When, let's say you're in a trade and you've bought a trade, let's go back to our chart. And let's say you put a market order here and you're already in, and let's say you're already in at this price. I'll also explain TradingView in a bit for people that are completely new, so I can show you guys what TradingView is and what this all shows. But let's say when you're in a trade and you're entering at 606.66 cents, and you did a market order and you're filled at 606.66. And let's say let's say you're not watching anymore or whatever, but let's say you're very firm that you want to sell at this price range. You could put a limit order there. So even though the price is not there yet, so let's say you're watching it like this, so even though the price is not there yet, you could put a sell limit there already. So your intent to sell your shares, your contracts, your car at that specific price, which is higher than the market's price. And that's your intent of selling. And if it gets there, you're going to get filled. And that's how limit orders work. So as it says in the name, it's a limit order. So once we get there, once we dip down for a limit buy, we buy. And when we get up for a limit sell, we sell. And the market orders, as you see, a market execution is execute immediately at the market price. So those are the only 2 things which are relevant for you guys. The rest, the stop order is a buy, sell, and sell stop. We're going to get into that in later episodes on how I use them. But that's sufficient for you guys that are just starting out. Consistency is everything. As I said, I've spoken a lot about consistency, and I'll probably keep on going about consistency. Pick one plan. Choose a single strategy and commit to it. You need commitment in life. You can't be hopping from one lady to another either in life. You need to be committed to one lady when you're married. So just like your wife, when you're married, you got to be committed to it. You got to be committed to learning your strategy. You got to be committed to applying those strategies perfectly, with discipline, with consistency. And you got to stick with it. Every strategy has a learning curve. Give it time to work, give it time to work, There you go. Let me pull this up. Quick little sketch from the internet. Looks like fun. So your experience time, it's a curve. It goes up, market goes up, your learning experience goes up, goes down, goes up. Most of the people in life, whether it's a business they start, whether it's a degree they start, whether it's trading they start, they get to this point, they start seeing the dip, and this is where they're done. So when we get there, this is where they're done. They ignore, just like the diamond guy, and I'm probably sure you guys seen his picture all over the internet once in your lifetime, but you need consistency. You can't stop when you're just about to reach these levels, and this is exactly like this that I deleted. Most of the people are here in their journey, and then they give up before they see the real growth. But will you see the real growth if you're not putting work in, if you're not putting screen time in, if you're not putting the things that are required, the time you need to put in, and the discipline you need to have to be able to make it within trading? Will you see that upwards curve? No, you're not. So very important to keep in mind. Do not give up. Stay committed to that strategy. Anything in life, anything, whatever you do, you're gonna have a initial easy learning curve, a dip, a pump back up where you're finally thought that you understand everything. You're going to see a massive dip, and within that massive dip, you're learning a lot, but it's very demotivating. It's not encouraging you to continue. And this is what separates you being able to continue and from the rest. Most people, just illustrated by that black line, is where they stop. Don't be that guy. If you have it within you, if you're disciplined enough, if you know that you could do it, please don't let a dip in your learning curve, a dip in your trading journey stop you from achieving what you could have achieved. Or else the only thing you're going to be doing is second guessing yourself when you're older. What if? And what if is the most painful thing that anybody could do. You know, I'm 25 years old, and considering to most of the people, I'm not that old, but I'm 25 and I already have a lot of what ifs. What if that I did continue that? What if I did do that? And I'm pretty sure if you go ask your parents or an elderly that you love and ask them for an advice, the only thing they tell you, shoot the shots. Just shoot for it. Just go for it. If it works, it works. If it doesn't, you've got nothing to lose. And the regret is the biggest thing that every elder has in common. So please don't be that. And I'm genuinely serious. If you have it in you, it would be a shame if you didn't make it. So stick to it, be disciplined, be consistent, do not be strategy hopping, and you're going to make it. Simple as that. Consistency in the market. Consistency isn't just for learning a strategy, it's crucial for trading. If you can't repeat the same setups and risk rules every day, you just won't last. Let me pull up my trading results. Once again, those trading results that I'm about to show you, completely irrelevant. You shouldn't even get fooled with it. This is how I trade. I haven't had a single red day in November. How am I able to do that? Consistency. I'm able to consistently take my trades. If they're there. That's one of my last trades. I bought as it brought my 1 minute bar. I'll get into that, my strategy, whatever. I saw that the sellers were holding it up. I saw that the market didn't want to go up. I went out. I'm okay with going out with not making money. I'm okay with that. And sometimes it do be like that, you know? And you could see, those are all my trades. I have all my trades on there. You could join my Discord in the meantime, go over my trades, but I'm going to get overwhelmed with it. I'm going to go over them in episode 3. I'm going to go over my strategies. And see, you could see I take losses as well. You know, I take massive losses as well. $500, $600 losses as well. But I make sure that they're within my limit. They're within my risk. I consistently take my L's. I consistently take my W's. So even my losses are consistent. You know, I can't be making $500 a day. The next day I make 200. The next day I make 10,000. The next day lose 2,000, and then the next day lose 20,000. There is no consistency. You need to be consistent. I beg you, if you're gonna start trading, consistency is the only thing you need. Discipline and consistency. Be able to follow the trading strategies that I gave you. Be able to follow the framework. Be able to follow the entry models and the exit models. If you're not able to do that, saying it again, you're not gonna make it. So yeah, it's everything is considered. You'll see that all my trades are all within the same level of consistency. But yeah, enough of that. No consistency equals no success. I can't emphasize it that's enough. It's non-negotiable in trading. You could tell that to anyone, everybody, even the gurus, the fake gurus will tell you the same thing. The people, the gurus that only make money, that don't even make money. They only make money by giving retail traders, starting traders like you hope. They will even say that. So the biggest mistake beginners make is strategy hopping. I think I've spoken about that a lot. With everything in life, when you're just starting your bachelor's degree and you're studying financial economics, or you're studying business administration, or you're studying civil engineering, you can't just go from first year civil engineering, second year mechanical engineering, third year aviation engineering, fourth year do economics, fifth year do business administration. You see, you're gonna be in that loop where you're doing the first learning curve, you get the dip, you go back up, you get that dip down, and you stop. Everything you did in life continued, whether it's your studies, whether it's your work, whether it's trading, you have to continue. You can't just always start something and stop something halfway. Have the will, have the urge to continue, have the discipline, have the commitment to continue. And that's for anything in life. So the biggest mistakes beginners make is strategy hopping. They try a setup for 2 days or strategy and it doesn't work perfectly. And they instantly think, oh no, but this doesn't work. Oh no, I'm not going to trade that way. Oh no, let me learn something else because on internet I see someone with a 90% win rate. That's bullshit. Complete bullshit. It's fluff, marketing gimmicks. You know, it's okay. I have a 60 to 66% win rate ratio. So that means out of 10 trades I take, I lose 4.5 trades. You know, I lose 4 trades. So when I trade my setup and today the setup works, tomorrow it doesn't, the day after it doesn't, completely normal. Statistics already tells me that it's normal that I think it was 13 days, that 13 times in a row is very normal for my setup to not work with a 60% win ratio on a specific setup. So I'm okay with losing 6 times in a row, 7 times in a row. But I have to take the losses consistently. I can't get mad. I can't be raging about it. I can't be losing my temper. I can't be getting mad and the third time when I'm taking the third L and the fourth trade go full size, go all in and hopefully make it all back. It doesn't work that way. It's normal to have red days. It's normal to lose money. It's normal to, everybody loses money. Anybody that shows you that isn't losing money, they're lying. Do not get fooled with my November results. Yesterday, the day before, when I started trading, I didn't take a single day when I had the perfect opportunities, and yet I make mistakes as well. I'm getting fooled by my own green streak. I'm scared to take my setup. I'm scared to take my trade because I'm trying to have that perfect marketing November green results. And that's for everybody else. Go look at my July results. Go look at my August result. Yes, I made money. Yes, I was profitable. But look at how many else I have. Look at how many trades I've lost, and it's very normal. It's very normal. June, May, I was red. I was red for the month. It's normal. Do not get fooled with it. The biggest mistake beginners make, strategy hopping. They try a setup for 2 days, doesn't work perfectly, and they abandon it for something new. This cycle repeats endlessly. As I said, civil engineering, mechanical engineering, aviation, pilot, financial economics. It's a cycle, never-ending cycle. You're never going to be somewhere. You always start something, get to a point, go back to the same starting point. This cycle repeats endlessly, and they never actually master anything. The reality is that every strategy has losing traits. Every approach requires time to understand its nuances. If you constantly switch, you'll always be a beginner, never reaching the competence needed to be profitable. Commit to one plan, just like committing to anything in life you do, anything in life you start. Execute it consistently, refine it based on your data and experience. That's how you build a foundation for long-term success. Once you ever get to a point, trust me, you can hit me up even if I'm ever done with this whole content or whatever, and I'm secretly trading somewhere peaceful in life. You can always text me about data. I'm all about data, and I can help anyone that's as interested in data just like me. And you'll get there. Essential tools and sessions, what you need to get started. You've got brokers and prop firms. You've got trading platforms. You've got basic tools. Brokers and prop firms, they allow us as retail traders to open an account, have access to the financial markets, whatever markets you talk about, indices, commodities, equities, blah, blah, blah. Brokers get direct market access. With brokers, you have to use your own funds. With prop firms, they give you market access as well, but you have to get funded, you pay a fee, and you get funded with them, and you trade their capital. And the only thing with prop firm is you got commission and rules. So you have to know that before you get their capital, you have to pass a certain phase, or you could pay a bit more money to get an immediate funded account, but we're going to get into that. And if you join my Discord, I can also walk you guys through how prop firms work. And I also have another video about how prop firms work on my YouTube channel, so I'm not going to get too in depth about it. But the difference between brokers and prop firms are brokers, you have to have your own money ready, and you'll be trading with your own money. So that's one thing. The other thing is trading platforms. What I just showed you guys, which I can quickly go back to. Let me delete those things. This is what I call TradingView. TradingView is the most used tool that every trader uses. Whether you're a professional or not, everybody uses TradingView. I have a premium plan with TradingView, but you don't need a premium plan. The basic plan also allows for the same things. And what you see right now is a chart, which is a collection of 1-minute candlesticks, and every candlestick represents a minute from market open. So this is where the market opened. This is the pre-market. This is yesterday's night session, after hours, and then so on and so on. So we're still, while filming this recording, we're still in the pre-market session, and the market didn't open yet. It will open in 20 minutes. So this is where your watch lists are. So this is your watch list. This is every ticker I follow. The QQQ is the same like the NQ. The IWM is another indices and a small cap ETF. And then you've got Amazon, Master, Tesla, Nvidia, whatever. Those are different time frames. This is your drawing tool. So for me to make a green box or red box, that's how I do it with, where I mark certain strategies with, which I will get into. This is a buy indicator, and this is a sell indicator, which you could calculate risk with. And in the risk management session, I'm going to go over that. But so there was TradingView. Analysis and journaling purposes could be done on there. Your analysis mostly done on there. That's what we call the charting platform. And then you've got basic tools. What are basic tools? Basic tools are economic calendars, where you could search up your economic data, red folder news, where it has high impact on price volatility. So let's say when they're releasing inflation numbers, such news have huge impact on the market. So when inflation numbers come out and they're worse than expected, or they're better than expected, it influences the market in either direction, and you're going to see massive spikes. And this is what every trader does. They check the economic calendar before they start trading, so they know what to expect and what time they're being released. And then you've got trading session and market hours. Market hours is New York time, 9:30 till 4 p.m. That's what the normal market for equities operate. That's where the most volume is. And I think that's what 80% of retail traders trade. Then you've got a London session. London session is for European people. 9:30 London is where the London session starts until 4 p.m. European time, which is 3:30 a.m. for you. 3:30 a.m. for you guys in America. And that's about it. Crypto markets, 24/7 open. It's the only market, because it's unregulated. It's 24/7 open. Yes, during certain times of day, especially during the New York session and London session or whatever, you're going to have more volume, more volatility. But the crypto market is traded 24/7. Stocks will be closed at 7 p.m. New York time. And I think 7 p.m. plus, 10 p.m. New York time. Still continues another 6 hours, but irrelevant. The only thing you should be focusing on as a beginner is training the New York session. And that's what we do as well. So don't worry about that. Things not to do. Beginners make predictable mistakes. Avoid these traps and you'll be ahead of 80% of the new traders. Catching every move. You don't need to be catching every move. So when you're looking at the market, when you're making money on this move, which we did yesterday, when you're making money off this move, it doesn't mean that I have to make money on this move as well, 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 on this move as well. You don't need to be making money as this whole move goes up. Impossible. You could be making money from entering here, taking a quick scalp, and making money on this small range, but you can't be, most of the people, they can't be trading every move, and if you do focus on trading every move, that's where overtrading comes, and that's where you're losing money. Trading without a bias. Every day you got to have a bias. When you're starting your market journey, when you're starting your trading day, you got to have a bias. You got to know what you're looking for. That's what we call the pre-market plan. Trading every session. Do not be trading every session. Trading every session leads to overtrading. Simply no, don't. Everybody tells you that, stick to that. Do not do that. Taking random breakouts. If you do not understand what breakouts are, I'll explain them in the coming episodes, but taking random breakout is something that what they learn is that if this market goes here, they're like, oh, okay, it already broke this level, so we're making a higher price level in general, so I'm going to go long. And then, bam, you've lost money. So do not trade random breakout, trading right after news. News, as I said, is very volatile, especially big impact news. Be careful with that. You do not need to be trading before and after news. Let price settle. Else you're gambling, because news makes unpredictable moves, which you cannot really have a strategy for. And if you're trading news, you're gambling. Over leveraging. Have a fixed, consistent position sizing. Do not be trading with 100 shares today and 1,000 shares tomorrow. You're simply just gambling. Consistency, once again, consistency. No stop loss. Hope and hit is what I call it. A lot of people just hope. They just long or short, they buy or they short, and they're like, yes, I'm pretty sure this is gonna work. And then the market just goes down and they're like, no, but I'm pretty sure. Show you an example. Let's say they short here and then they short here again, and they're like, okay, but surely we have to come down. And then they add more shorts here, and then they add more shorts here, and then they add more shorts, and then, yeah, but okay, we went up so much, surely we're gonna come down. And then by the next move, you're already blown. Your account is gone. 3 months, 4 months of hard work, completely gone. Do not do that. Always have a stop loss. Always know what you're risking in a trade. So when you enter a trade, and let's say I'm short here, this is my risk, 76 cents on the QQQ. If I'm trading 1,000 shares with 76 cents, I'm losing $760, and I should be okay with that. I could be calculating what I want to risk. Always trade with a stop loss. Over leveraging, no stop loss. expecting signals. As I said, nobody's going to do the work for you. Nobody's going to make you rich. Don't believe in that. Strategy hopping, talked enough about it. Be consistent. Do not go from one strategy to another, just like you don't go from one wife to another every single month. Simple introduction to risk management. What is risk management, you could say? What is a stop loss? A stop loss is where you call it quits on the trade. If you're in a trade and let's say you're buying QQQ right here at 604.73 and I'm long, I should know which level. If the markets come to a certain area, where do I invalidate my trade? So if the markets come here, I should be okay with getting out of that trade. Then I'm wrong, accept that you're wrong, and do not be holding it all the way through if it comes here, holding it all the way through, it goes down, holding it all the way through because you're gonna blow up. A stop loss allows you to protect yourself. It protects you in the long run. It protects your capital, it protects your sanity, it protects your mental health. Always use a stop loss, so you know what you're risking before even entering a trade. What is risk to reward? Very big concept. When I enter a trade here, and let's say I am risking these lows, do you see what I'm risking? So let's say I'm risking 38 cents here. Let's make it simple. I'm going to make it 50 cents. So yeah, I'm risking 50 cents now. As you can see, I'm risking 50 cents and I'm making $2.25. Let's make it $2. This is simpler. So now for every 50 cents I'm risking, I'm making $2. So I'm having a 4 risk to reward. So when I'm risking $1 on this trade and I make $4, I made 4R. That's what we call R. That's the risk to reward. The risk that I had compared to the reward that I made. And this is a very key concept in trading. Without a risk to reward, you're not going to get anywhere. A mix of risk to reward and a mix of the probability of you winning your trades, the percentage of you winning your trades determines your profit factor, and that in turn determines your profitability. Without risk management and risk to reward, you're not going to make it again. So I'll have a separate episode. The risk management and risk to reward is so important that I have a whole separate episode, probably going to be episode 4, all about risk management. And no need for a high win rate to be profitable. And as I said, a lot of people think that you should be winning every trade in the market to be able to win. Doesn't work that way. You can win 5 out of 10 trades, and with a risk to reward of 2, you're already winning. So you could win 50% of your trades and you could still be profitable. You can win 30% of your trade and with a risk to reward of 3. So for every dollar you make, for every dollar you lose, you're making 3. And only if you win 3 out of 10 trades, you're still profitable. So don't get fooled by that. You don't need to be winning every trade, and you can't win every trade. It's bullshit. You're not going to win every trade. Nobody can do that. Nobody can take 10 trades in a row and win 10. Or let's make it even a better sample. Nobody can take 100 trades in a row and win all 100. That's bullshit. What keeps us in the long run is being able to make more than what we risk. That's what keeps you in the long run. Trending market versus ranging market. Market conditions. I'm not going to get too deep into that. But what is a trending market? Well, we had yesterday, this part from here to here is the trending market, where the market moves up without any choppiness. And this part, what we had here, which I've highlighted, is what I call a ranging market. And then obviously the higher time frames, markets are fractals. It happens on every time frame. So this could also happen on the daily, it could also happen on the hourly, it could also happen on the 4 hourly. So this area here, that's a ranging market. That's where there's a lot of choppiness. And this area here is a trending market where the market is very nice. It's moving in waves, and what I call it's moving in Z shapes. We'll get into that all later down in the episodes. And that's it. We'll dive deeper into risk management, position sizing, advanced concept in episode 2, which is episode 2.2. For now, focus on understanding these fundamentals and applying them every day. So a quick note about risk management is that you should find a perfect balance, which I will help you and I will guide you through that. A perfect balance between what is a good risk management and how you determine your risk management, and which setups will have a higher risk to reward and which setups will have a lower risk to reward. So on which setups could you expect to make more money on the amount of risk you're doing and on which setups will you only be making the same amount of money that you're risking. And that's a very key concept that we have around here, and we'll get into it in episode 2.2 and episode 3.3. And it's a continuous going theme that I'll be continue talking about risk management and risk to reward, because it is the fundamentals of trading. And for now, I hope that I'm able to give you a bit of an explanation or a bit of understanding on what risk management is, and on what the risk to reward is, and what the stop losses are. And as I said, I think I should be here near the end. It's an hour and 10 minutes recording, but I hope that I was able to really give you the basics, the foundations, the tools, and everything, and explain a bit about how the markets behave, what to use when you want to start trading, etc., etc., etc. So episode 2.2 will also be recorded hopefully today, and going to be all published on YouTube. Join our Discord. I'll have everything up on my Discord. I'll have we're online there 24/7. So if you have any questions, I'll be answering them. And if you join my Discord as a beginner, don't get overwhelmed with all the information there. Don't get overwhelmed with all the strategies. Don't get overwhelmed with all the execution and charts I have on there. But just take a skim and learn from it. Let's put it that way. For now, just focus on everything that I taught in episode 1, that I said in episode 1, and that I semi-taught in episode 2.1. And take those core basic principles, get familiar with learning how to use TradingView, get familiar with prop firms, get familiar with brokers, join our Discord, and I could even go more in depth about it. And then later on, we're going to get into all of those indicators, those lines that I have, what strategies I use, what those purple lines are, etc., etc., etc. And yeah, so for now, just to recap, risk management, risk to reward ratio, most important thing for now for you to understand. For every dollar you lose, and you make, let's say, $5 for every dollar. So if you're risking $1 and you're making $5, that's a risk to reward of 5. And if you're losing $1 and you're making 50 cents, that's a 0.5 risk to reward. And it's very, very important to find a perfect balance. And I guide you through that along with your win ratio and everything. So yeah, I think it was a good session, good episode 2.1, good introduction to the basics on what tools to use, what TradingView is, what prop firms are, what brokers are. And I'll catch you guys in episode 2.2. We do this all for free. The only thing that I'm asking is leave a like and just subscribe. Leave a comment perhaps as well. Really appreciate it. Really makes me happy. We barely get comments, so any comments you guys make is immediately seen. And for the rest, I'll catch you guys in the next one. Bye-bye.